Hello traders, hope you all are doing well. This is Trader Ed and we're back with another video. Well, today I want to be teaching you guys a strategy I used in taking the trade in my previous video. If you haven't watched, go back and watch, see how well it played out. So like I promised that I was going to teach it here, guess today's that day. So let's hit the chart, let me show you how I came about the trade. And before we do, support the channel by subscribing, give a thumbs up, drop a comment down below so the algorithm can refer this video to another individual just like you. So let's see the chart. Let me show you how we do it. Love.
Yeah, so hello guys, welcome to my chart. So here's the framework of the strategy. As I promised I was going to teach this strategy, so pay close attention. So from here, why I mark Asian, this white line, let's take this to be the Asian session. All right, so let's take this to be the Asian session, and then the red line, the London session. All right, so the strategy is simple, quite simple. It has specific rules to follow. You must pay attention to the rules. All right, so here is the logic behind it. During the Asian session, the market tend not to move rapidly. The volatility is normally low. So what are they doing during the Asian session? They are building liquidity above. Liquidity is built above here, and then below the Asian session you find liquidity. So after the Asian session finishes and then London session starts, when London normally kicks off around 8 a.m. Nigerian time, 8 thereabout, 7 o'clock they are setting the market for 8 o'clock to move. So around 8, that's when the real 8 a.m. in the morning Nigerian time, that's when the market normally start moving with volatility. So this is the Asian session. So from London session, so the market came down and then took the liquidity below the Asian lows, broke it here, went down, took this liquidity, and then from here you don't do anything. You're not start doing anything. You're just still watching to see what the market will do. So this move down just came to take liquidity, and then when things will start getting interesting is when, after taking this liquidity, then the market goes back up and then breaks a structure, the structure that formed before taking the liquidity. In this case, I am also a supply and demand trader, so I'll use supply and demand terms. So this is supply, this is demand. So now the last supply the market formed that came down to take the liquidity, this last supply here, once the liquidity has been taken and then the market goes back up and then breaks the supply that was created, and then before taking liquidity, when the market goes up and then breaks it, not with a wick, with a candle, a body, a full, once it breaks it with a candle close, once a candle close with the body above the supply that took liquidity, then the market has given us a direction that, okay, we should be expecting bullish movement. All right, so now how do we enter this move right here that went further to take, that breaks this structure? We look back down and then look for any demand that was created. This right here, the demand could be an order block, it could be a fair value gap, it could be anything, but anything that in the first market we regard as demand, or any support that you find around this area. But normally it's either an imbalance or an order block. So once the market breaks this structure, you come back down and then look for the demand that was created, and then you mark it out, and then you wait for the market to come back down to retest that demand. Once the market comes back down and then gets the demand, that's where your entry will be. So this right here will be your entry, and then for TP you target the Asian highs, and then your SL will be below the demand lows. So that's it. First, you mark the Asian session, and then market comes back down and then takes the liquidity below the Asian session. You take note of the supply that was created before the liquidity was taken. So once the market goes back up and then breaks that supply, you take note of the demand that was created down here, and then you wait patiently for the market to come back down, and then once it gets to that demand, that will be the entry. And then for targets, you'll be targeting the Asian highs. Your SL will be below the demand low. It must not be that the market will come down. It must not be only during the London session. This drop down could be during the New York session. All right, so take note of that. It mustn't be only during the London session. So, but once the market has broken the structure that took liquidity, that has shown you its direction, then you look for the demand. It might be an imbalance or a fair value gap. You place your limit order here, your stop loss down, your TP targeting the Asian highs. So you wait patiently for the market to come down and then fill you in. Then you ride. If it doesn't come down to fill you in, if it doesn't come down, then this will be a miss entry. You don't have a trade for that day. The market must come back down, tap the demand for it to be valid. We are not chasing the market. If it goes and then continue going and then doesn't come back down, then we don't have a trade. We must come back down to fill us in for us to be able to ride targeting the Asian highs. And then reverse will be the case for a sell scenario. In a sell scenario, it will be that after the Asian session has been created, the market will not come back down. It will go back up to take the liquidity up above here, and then once it goes up to take the liquidity that's resting above here, and then it comes back down to break the demand that was created to take the liquidity here. Once it breaks it, then the market has shown you the direction that it wants to come down. Then you must wait for the market to go back and then retest the supply that was created during the time it took the liquidity here. I'm explaining for a sell position. All right, so the market must go back up to tap that demand before you ride and then targeting the Asian lows. That's for a sell position. But I'm giving you this example visually for a buy position. First Asian session, you mark it, and then you take note the market falls down and then take the liquidity. You mark the demand, the supply that was created last before it took the liquidity here. Then once the market goes back up and then breaks that supply, then the demand that was created down here, you mark it, and then you wait patiently for the market to come back down and then tap you. Once you're tapped in, you ride and then target the Asian highs. As simple as that. So let's look at it on the chart. The real example, the trade I took on my last video. So let's see it for itself. Alright, so here is the trade. So it's simple. You can even do it yourself right now, just like I have explained. You can see it for yourself. So the only indicator, I don't use indicators. I don't use indicators on my chart. The only indicator I use is these Q zones. That's Q zone, Joshua, indices, label, so that and that. This indicator will automatically mark the ASEAN session. This green box here, this green box here is the ASEAN session. And then if you look here, there's a blue line, you see London Q zone, and then this is the New York Q zone, just for me to know the Q zone, the sessions of the day. So here is the ASEAN session. So look, just like I explained, this is the ASEAN session. So after the ASEAN session finished, during the London Q zone here, the market came down and then took the liquidity that was resting below the ASEAN session. After taking the liquidity, the market went back up and then broke structure here. This was the last supply. This was the last supply that was created before coming down to take the liquidity down here. The market went back up and then broke it here with a candle. Remember, I say candle's body. So it broke it. So after that, I just knew automatically I will be going long because it has broken the supply that was created and then took liquidity down here. So I simply placed my limit order here. In this case, there was an order block and then there was a fair value gap. So I placed it above the order block, because sometimes the market will not really come down to fill all inefficiencies. So I place the limit above the order block. So just like I explained there, that the market will not come down during the London session. For this example, it started around the New York Q zone. That was when the market started coming down, back down, and then it filled me down here during the London Q zone, and then the New York Q zone, and then it went my direction. So I came out of the trade here. I came out of the trade around here, this imbalance, because it was getting to the close of the market, and then I was okay with the profit I made. So, but nonetheless, the market still went and then it still hit our TP. Still hit our TP here at around here, but it was the next day. I am a day trader. I don't normally hold for days, so I can see from where I came out, the thing came back down to almost my entry point before going. I don't like holding till the next day, so that was the reason I came out at around here. So that was it. It was quite simple. And then so you must learn to watch it over and over again so you know the rules. I explained everything perfectly well from the sketch up. So listen to this over and over again, then go to your chart and then try to find it. Then reverse will be the case for a sell setup, but I won't give you that example here. Alright, so that was it. This box right here means something more deeper, but this will be for my private students and people that are in my private community, for you to know what this box is. But it does not really matter. It matters though, but then with everything I explained, you can still catch this trade. But then this right here means something, and it's more refined, but then this is for my private students only. So I believe this will help you pass your prop firm accountant, or you can just stick to this one strategy. Thanks for giving me your time. Alright, so see you guys whenever. Alright,
Yo guys, so yes, that was it. Short, simple, and straight to the point. I'm not saying this works 100% of the time, but I can tell you for free that this works 70-65% of the time. So if you can just stick to only this strategy, just wait for all of the confluences to come together. If they don't come together, don't push the buy or sell button. But if you see all of the confluences that I showed you there coming together, don't hesitate to push the buy or sell button. And then keep your risks tight, risking 1% of your account, targeting a 1:2 or highest a 1:3. Just target just target the next highs. If you can target that, it can give you sometimes a 1:3, sometimes a 1:2. So if you can stick to that only, backtest it for yourself. Let's say backtest it for a month. Every day, backtest it. If you see it come, backtest it on a demo account until you're confident enough to like use it to enter real market conditions. So if you can stick to it for like a month or two, just you don't do any other thing else but paying attention to this, following only this strategy, I can tell you for free that you're going to be profitable. What's missing in your trading journey is first having a strategy that you trust, and then secondly sticking to your risk management. You've seen a couple times whereby you're trying to follow a strategy and then it fails, you try it again and then it fails, and then you switch, trying to go and like learn on that strategy. You doing that, you not being able to stick to one strategy even when it fails, that's why you're still not profitable yet. But if you can stick to the strategy even when it fails, but stick to it, give it a length of time, because this industry is not, you should not be looking at the short-term result. Give yourself time, like always look ahead, always give yourself like 6 months, try something. Don't say I did this for 2 weeks and then it stopped, it did not work, and then you stop using it. No, just this strategy. I just thought if you can stick to it, try to stick to it like 2-3 months and see, come back and tell me if you're not profitable. But you can stick to it where you can still stick to the strategy and then your risk management is not tight. Let's say you're not risking 1%, you're risking like 5% of your account, 10% of your account. I'm not saying this works 100% of the time, so I'm not giving you a license to go risk 10% of your account, 15% of your account. No, I said risk 1 at max 2% of your account. That's it. Following this strategy, then go pass your prop firms, go watch yourself become profitable. So thanks for giving me your time. See you guys on the next video. I don't know what my next content's gonna be, but then I'm sure I'm going to post a video very soon. So see you guys on the next video. Don't forget to subscribe, don't forget to hit that like button, don't forget to comment down below. So let's put my face in the face of another individual. So see you guys soon. Love.